But what about until we get that powerful economy? Is the market still anticipating a recovery? Is that what it's all trading on? Well, one place to look for some clues, we know, is the shipping industry. This is taking stock on Bloomberg. Now, the shipping industry is seen by many to be a bellwether for what the broader economy does. My next guest covers the shipping industry as an analyst for Lazar Capital Markets. Urs Dur, welcome. It's good to have you with us.
Great.
You've just been out traveling, finding out what's going on in the world. Let's start with the bulk shippers. We all want to know iron ore contracts, China, stockpiles. What's the situation with the bulk shipping industry right now? Day rates?
Day rates are very, very good, way ahead of most, even the optimists' expectations at the beginning of this year, and I was one of the optimists, so they've beaten mine. It's largely driven by China and China's immense appetite to import specifically iron ore, which is very attractively priced overall, even at delivery over domestic ore. There may also be some stockpiling on their behalf simply on a dollar reflation trade as a hedge. So there is sincere demand from China. The end-user demand is less of an answer right now. So there's a big question mark about how strong the market really is.
You make an interesting point, though, because one of the things you kind of hint at is that if iron ore is on sale, in this environment,
sure,
why not buy as much as you can? You're going to eventually use it, and it doesn't go bad.
Sure, it can, but in general, that's absolutely correct. As well as the Chinese have a long-term view. But we are seeing that their iron ore inventories, while high, are not piling up as fast as they're importing it. Steel prices, while not high, have been ticking up. Steel inventories, while high, have been slowly but surely ticking down for the last few months. So there is some consumption. So we're relatively bullish that there is actual consumption in China. We have to see the rest of the world tick up, too. China can't lead it forever out of the abyss. But certainly it's a lot better than where it was, and the long term is much brighter today.
All right. Now, one of the companies I know that you've been following and we want to talk about, get your insight into, this has to do with dry ships because, as we mentioned, maybe the Baltic Index or the shipping world as a proxy for global economic health. Dry ships, it certainly trades as though it is a proxy for what goes on in the shipping industry. Is that right?
Yes and no. Of late, it hasn't. It's issued an awful lot of equity, had some difficulty with its debt covenants and had to get waivers, as well as had to issue equity and get in better favor with its banks. Still has some good exposure to the dry bulk spot market, specifically on the Panamax side. But investors are fairly wary of the stock. But they're in much better shape than where they were before. But still, against next year's valuation, they're fairly valued. I have them at a hold. Diana Shipping has a much better balance sheet, and I think it's much more attractive to investors as the market comes back, especially for 2010.
Let me just press you a little bit on dry ships. We'll get to Diana as well. But with dry ships, you have an ownership structure that included, I believe, a spin-off, a company that was then looking to do deep-sea oil drilling with ships, and a company that was also controlled by the same CEO and founder of Dry Ships. Sure. Can you give us an update?
Yeah. Dry Ships has 6 drill rigs on its books, 2 that are operating right now, ultra-deepwater drill rigs, very high-value contracts going to the oil majors for multi-year contracts. Certainly, we're going to have to drill for more oil going forward. They also have 4 more that are due for delivery in the coming years. They are going to need some financing for that. That remains a question at this point in time. But again, you're dealing with oil major credit on the other side, so they should be able to get it. I think it's a matter of value for Dry Ships as to when and if they spin it off. I would sort of look for that in 2010 as a possible spin-off. There's value in those rigs, but again, they went from 40 million shares in fourth quarter of last year to 252 million shares today. So there remains an awful lot of uncertainty around the name. A lot of investors who are just frankly tired of it. Eventually, that value will return, but at this point in time, it's fully valued on next year. But again, the drill rigs next year, that has value.
Okay, all right. And now let's step back. Let's look at Diana, because that's a different animal. There are no drill ships in the Diana portfolio.
No.
But what about the new ships, the new build coming into the market? Or is that not happening because of credit woes?
The order book for dry bulk ships is huge still, but it's shrinking very quickly. We're seeing what is called slippage, which are ships being delivered late. A lot of that slippage is going to turn into cancellations. There's no new financing for ships right now, and ships that were ordered speculatively without financing or contracts attached simply are going to have a very difficult time getting delivered to the owners who ordered them. Many of them just simply will not be delivered. On the other side, China and Korea will probably support their shipyards in some degree. So there's a lot of ships being delivered. It's going to keep a cap on the high end of the market. We're not getting back to record levels that we saw last year and the prior year for many years. But good rates, better than what we saw in fourth quarter and first quarter, are certainly on the books.
Well, they were lousy, right? I mean, the fourth quarter and the first quarter was like a big write-off.
It was basically zero, right? But these companies are going to be profitable, and many of them have much better balance sheets today than they did then.
Would you be buying the shares in Diana right now?
Absolutely, yeah, absolutely.
And this is a turnaround on that whole issue of going back to iron ore shipments.
Sure, they're fully contracted for this year. They have some good exposure to next year where we think rates are going to be on average better year on year. Near term, it's very strong now, as well as they have a net cash position in their balance sheet. I don't know many companies that have that anywhere.
And that's pretty important, you would imagine, in the shipping business right now. You don't want a lot of bills coming due because otherwise you're going to have to refinance.
Negative net debt right now, buy low, sell high. It gives them a lot of dry powder to buy assets. They could grow. They also are not encumbered by their banks. They're not under waivers for their debt covenants. They could bring back their dividend if they so chose at any point in time. When the market gets more stable, I think they will.
Okay. All right. We're going to continue the conversation. We're going to switch from talking about bulk shippers. We're going to talk about the tanker business. This is Taking Stock on Bloomberg. I'm Pim Fox. My guest is Urs Dur, analyst with Lazar Capital Markets, expert in all things shipping. Urs, let's turn our attention now to what's going on in tankers. This is all that liquid crude that we all love to know about, as well as petroleum and refined product. What's the situation in the tanker business? Tanker rates, where are they going?
Well, they're going up for the near term, but they're coming out of a deep abyss that really hit them hard across the board in March. Really what's been driving rates this year is contango in oil pricing, which has caused a lot of storage on VLCCs or super tankers and Suezmaxes around the world.
Contango, that's the fancy term that we use to describe what? That the future price is a lot more.
Future price is higher than the current price.
So put it in storage and wait until the future rewards you with higher prices.
Buy it physically, sell it forward in an immediate contract, store it until you have to deliver it, and hopefully, obviously, that storage price, that arbitrage, doesn't change with the storage of the oil. That's taken a lot of ships off the market.
So they're basically like floating storage.
Floating storage, and that's taking capacity off the market, and that pushed rates up in the first quarter. Rates did come down significantly in the second quarter, just a real slowdown in demand, a little bit of flattening of contango. Now we've got more contango again, as well as ship owners realized that there was still oil flowing, and they had probably become too conservative in their expectations, and now ship owners are getting more aggressive on the spot market and have been able to push rates back up to the $40,000, $50,000 a day range on VLCCs, and that is generally money-making rates. Still, the summer is going to be very tough for the spot crude tanker markets overall. Demand is still relatively low year on year. And so for the tankers in the near term, again, you've got to go with the best balance sheets. Which ones are those? I mean, I know you cover, for example, OSG, overseas shipping or ship holding. Do you like that? I'm a buyer of OSG. I like OSG. It's just got a very strong balance sheet. I think very good assets, 25% net debt to cap, if I recall correctly. And their dividends intact and, frankly, could increase with the cash flows they're generating. They may very well lose money in the second and third quarter, but they should also be, by my estimates, profitable, but the consensus is that they may lose money. But over the long term, especially against next year and the ships they have delivering, very attractively valued. TK I have as a hold.
That's another one. That's on TK. Well, I wanted to ask you about TK
because,
but it's complicated, right? Because in fact we were talking about it earlier today about how there's TK, which is the symbol TK. Then you've got TOO, which is the limited partnership, and then you've got TK as the tanker business.
And they had the TK LNG and TK Tankers, so they have three spinoffs plus
so
the
what is
corporate.
this? Okay, you got a parent company, TK.
Sure. And all of that is consolidated in. So all of their spin-offs, you can choose to invest respectively into specialized areas of TK, all of which have dividends that look fairly intact. And then you have the TK corporate, which does have more debt, but is still quite liquid today and doesn't have covenant issues with its banks. Still, I feel they're fairly stressed. The way their order book is structured and what they've been earning and their expenses, they're going to have a tougher time in the second and third quarter. And again, against next year, against ships that are getting delivered, they're simply fully valued at today's levels around the 20s. Again, a very good company. It's just a tough market.
All right, fully valued for TK. You like OSG better. Before we end, though, I want to get your thoughts because we're going to talk about containers right now. What's the market right now for the containers themselves, the boxes in the business?
It's difficult to say because there's rates. The rates are different everywhere, but there's signs all over the place that things are bottoming. We're seeing throughput levels slowly but surely tick up from the abyss in the United States. But also ticking up significantly in Asia. Rates are getting a bit better, and I think that market is bottomed.
All right, I want to thank you very much, Urs Dur, coming in from Lazar, capital expert in all things shipping.